Let me start by giving you some data in terms of looking back, and then I'll talk about some trends in the region, and I'll close off with a little bit of a deep dive on Southeast Asia specifically. I'm going to start with some data that is pan-Asia wide, because I think it's in that context that we need to think about investing here in Southeast Asia. So first and foremost, headline data on what happened in 2018. We had about $165 billion of private equity deal value in APAC last year. That was across about 1,000 deals. So you do the math, roughly 165 million or so in average deal value. What's perhaps more interesting is that we had about 140 billion or so of exits. And as you'd obviously expect in the industry, it's exits that will continue to drive the virtuous cycle here. If you have a lot of money going in, but you don't have a lot of money coming out, LPs are going to slow down their capital allocations to the industry. So we always want to see that exit number to be very close to or even higher than the money going in. What was interesting though, and of note, is that we saw fundraising slow down considerably. We had a couple of really good years in fundraising, and we saw fundraising go down to about $75 billion last year. Now, I often get people who ask me as I travel around the region saying, you know, does investing in Asia really matter? And of course it does to people who do that for a living, but in the context of the global stage, does investing in private equity in Asia really matter? And the short answer is, it absolutely does. And why is that? Well, you know, 10 years or so, when I really started focusing on this space, a little more than 10 years or so, we were at about 100 billion in AUM in Asia. We're now getting close to $1 trillion in AUM in Asia. And we were at about 10%, 8% at that time of global private equity activity. We're now 25, 26% to be exact of global private equity activity. So you can't have a meaningful LP conversation with most LPs in the world, or you can't really think about where you're going to generate alpha in this asset class without thinking about how you're going to be present in Asia when you're now 25% of global PE activity. Now, as I said, behind some of these positives on deal value and activity was this, you know, one observation, I won't yet call it a concern, on fundraising, where we saw a real flight to quality, if I can call it that. So over the last couple of years, we've seen the trend go from 750 funds being raised in a year down to 250 funds being raised last year, so a third the number of funds. The average size of those funds scale up from about 100 million to 300 million, and the funds who are raising, they're raising 10 to 15% above their target, and we know that generally most funds aren't exactly being shy about the targets that they want to raise. So when you put those dynamics together, a lot fewer people getting money, the ones who are getting money are getting more money than they wanted, and the averages are much higher, is really what we call a flight to quality, where winners are raising more and much faster while others are struggling to win, predominantly because they haven't generated superior returns for their investors. And part of the reason why, sorry, I hadn't shown you that that data. Let me just go back there. Sorry, that was the data on fundraising as I was speaking about it. So down to 250 funds, average of 300 million, and most people, winners, being able to raise more than they were hoping for. Now, one of the reasons why this is happening is valuations. And I know there are some in the room who continue to focus on sectors or types of businesses where they're able to get lower valuations. I was just speaking to Wai-san, who's going to be on the panel next, and you know, certainly what he focuses on, Novatellis, is in that vein. But average multiples in the region are quite high. You know, 14.5 times EV/EBITDA multiples, that's for Asia Pacific as a whole. If I gave you that same data for Southeast Asia, it's 12.5 times, so this is driven a little higher because of the tech deals in China. That's not exactly cheap. And when you survey GPs, so we recently surveyed 156 GPs in the region, 71% of them say competition and deal values are higher in 2018 than they were in 2017. So clearly, valuation is something that is, high and something to be thinking about. So that's some headline data from last year. Let me try and peel the onion back one level and give you some trends that are coming out of this data, because I think some of these trends may have implications for you, particularly if you're GPs. So trend one is we're seeing new sources of value really take hold in the market. Fundamentally, over the last 10 years or so of investing in APAC, people have, by and large, benefited from multiple expansions. They have also, as you would expect, focused heavily on growth, which translates to revenue. Effectively, revenue theses have been the core theses of most private equity deals in Asia Pacific. Leverage remains about the same, but the two factors that we are seeing take hold increasingly more, and this is validated in that same survey that I'm talking about with all of you, is cost and margin focus, where a third of you now say that's your most important factor, and bolt-on M&As, where 1 in 5 of you say that your theses are on the back of M&A and bolt-on M&A. And I think the interesting challenge that poses for some players is, do you have people in your organization, either full-time, part-time, advisors, what have you, who have these muscles, who have the skill set to go in and drive margin improvement or cost out and to really work on bolt-on M&As? Or have you built a shop that's effectively full of revenue and top-line focused people and also relying on multiple expansion? Because I think in the environment of the pricing that I just mentioned, it's unlikely that we can all assume multiple expansion, and you're probably going to need some of these other factors to be important. I think a second thing that is now omnipresent and is hard to dismiss as a steady state trend, and I say hard to dismiss because in past years I've had a number of people say, yeah, but it's a fad, it'll go away, I don't focus on it, whatever. But it's now hard to dismiss that 50% of all deals across the APAC region, and about 40% here in Southeast Asia, have a tech or internet or e-commerce component to it. Now, you might still decide as an investor that that's not a sweet spot for you, and that's absolutely fine. But how is this investing, half of the dollars are going into that space, how is that then going to impact the companies that you're investing in? Will they be impacted by all this money that's going into internet, into technology, into e-commerce, even if it's something you're not doing directly? And I don't think it's a fad because, frankly, there are so many reasons why this pace of digital change will continue. And we could do an entire session just on the drivers of that. But hyperconnectivity that's happening more and more in the region, the 40x increase in data over the next few years that's expected from the multiple ways now that we can track everything that's happening in our lives, and the continued exponential kind of computing power acceleration that we're seeing around us, allowing more and more smaller chips or devices to do much more than what it was able to do before. This will probably only result in more upstarts or digital natives emerging across many sectors, which will probably result in at least as much of that activity I talked about on the previous page, where half of the dollars are going into tech investing. And again, I point out, I'm not trying to say that you have to be in tech investing, but if half the dollars are going into tech investing, you certainly need to be thinking about how are the money going into those companies, how is it going to be impacting your portfolio companies and opportunities that you're in, or the exits that you'll have down the road. The third trend I want to talk about is ESG and responsible investing. And Europe has been the pioneer in this area, and in Europe there are now plenty of different metrics that show that smart, responsible investing has actually delivered return, not just been good to do. And 60% is the typical number. 60% of deals done with kind of significant ESG focus have enhanced financial performance. I have other data that shows, it's about a percent and a quarter on IRR for deals that are done in the last 5 years. Obviously, vintages are too young. So this trend is here to stay. In my work and travels with LPs, I know that this is something they are heavily focused on. I know there's some LPs in the room. And I liken this to what happened with portfolio teams or operations teams 10 to 15 years ago, right? Very few funds had dedicated ops people in their organization at that point in time. LPs started demanding it. It started with most funds would say, I've got one person who's my ops person or portfolio head now. And now if you're a scale fund, there's nobody I know of who doesn't have a value-adding component to their organization with ops teams, portfolio teams, so on. I think the similar thing is going to happen. I don't know in what time frame with ESG. Whereas the LPs are going to demand that funds have people who all the way through the investment process, finding the deals, doing the due diligence, adding value, and exit, are making sure that you are taking into account ESG considerations. You might buy that, but the issue is the following. The issue is, again, the same survey, 90% of you say, yes, we know it's important and we're starting to do something. Only 13% of you say, this is self-reported, say that actually we have truly incorporated ESG into any of our performance disciplines or any of our investment practices. So there is a gap between what you want to be doing and what you are doing right now. And I think over time, that gap needs to close, given what LPs are demanding. So that's my view on some trends. Let me now just close in the final minutes and talk a little bit about country perspectives and tee you up for ASEAN, which is going to be the next panel that you go straight into. Now, before we focus on ASEAN, I want to just give you some data. The reality is that if you think at a pan-APAC level, China and India have kind of really been the bellwether of the industry in terms of where the money is being deployed. And frankly, India, even you see it on the chart, is there, but it's still a fourth of China. So China has been where a lot of this money has gone in. I want to qualify, half that money in China is not addressable to most of you because it's domestic funds for domestic market. The other half of that money is kind of dollar fund investing. So most people think of that as two sub-markets, but when you add it up together, China is obviously very, very large. ASEAN is right behind that, right? ASEAN's kind of number 3. New Zealand, Australia, New Zealand, Korea, and ASEAN are now about all equivalent at roughly 15 billion or so. I'll show you the data behind that in a moment. What's driving all this investment in China? It comes back to trend number 2 that I was talking about, the Pan region. It's a lot of money that's going into the new economy. In 2013, 75 billion or so was the number that went into VC investing in China. Last year, 250 billion went into VC investing. On the right-hand side, I find this quite interesting. Over the last 6 or 7 years, non-tech investing in China grew at 1.5 times, 50% increase in non-tech investing in China. Tech investing grew at 21 times, 21x over that same 6-7 year period, right? So it's impossible to think of what's happened in the China private equity industry without realizing what's happened in tech. And we're starting to see, I'll say starting to see some of those trends here in Southeast Asia, where we're seeing the early stage VC ecosystem move from smaller ticket sizes to the billion-dollar type transactions that in some sense aren't referred to as pure VC, but they're going into early stage growth companies that are hard to measure with the typical earnings metrics and so on. We're seeing that come to Southeast Asia, and you'll probably know better than me how well is that trend going to accelerate, but we're seeing some of those same signs of what drove the momentum in China. So I promised this data a few slides ago. Southeast Asia for the last couple of years has kind of been at this steady state, 13, 14, 15 billion dollar level. Before that, the 6 prior years before that, the average was sort of 7 billion. It was hovering between 6 and 10. So I think the question is, has the market kind of gone to this next level, this 15 billion-ish level, double the previous 5-year average? I think part of that will depend on what happens on the right-hand side. So there was a very, very good run-up on exits, and that exit story drove fundraising back into Southeast Asia. 2018, we had a huge drop-off in exit activity here in Southeast Asia, went down to 5 billion. It was principally trade sales, strategic exits, and there was some secondary starting to happen. The IPO markets, as you know quite well, are pretty much dead right now in Southeast Asia for PE deals. So question for me will be, can we see in 2019 more exits happen? If we will, I think we'll continue that data on the left-hand side of 13, 14, $15 billion investments. I think if exit activity remains very timid, I think funds are going to have to focus there, and they'll struggle to put as much money to work on the left-hand side because they're going to need to clear their coffers and deliver returns to the investors. So in that, for you to consider, and as the panelists come on in the next session and talk about middle market investing here in Southeast Asia, but I'd leave you with just a couple of thoughts. Number one, I think where possible, not in all cases, but where possible, you've got to start taking a bit of an ASEAN perspective. As in, what can the companies you're investing in do outside their home market? I think it's now not so easy just to back winners in domestic markets. I think the easy money there, if you like, has been made. But how are you taking your company you're investing in, from Indonesia to Vietnam, or from Thailand to Malaysia and Indonesia and whatnot? Often you have to do that through M&A, which I talked about as one of the key drivers of value. I think second thing is talent. Talent is becoming really critical for value creation, given the shift I described in moving to not only revenue, but cost and margin improvement in M&A. Do you have the right talent to help you deliver on that? Do you have the right talent to assess digital and threats from the new economy? I think no deal right now, virtually no deal, is a do-nothing deal. So do you have an active thesis, even if you're a minority shareholder, as to what you would like to see be done in the portfolio company? And how are you harnessing digital technologies, given the change that's happening around us? And finally, I borrowed from Sir John Templeton, the investor who says this time is different. What I'm trying to say with that is, I think you really need to be thinking of, what is going to happen in a possible macro slowdown. I'm certainly not in a position to tell you if there will be a slowdown, where in the world it will start, when it will happen. I don't know that, but I think people who keep sort of saying, this time is different and we won't have a slowdown, having had a bull run for 9 years, might be proven wrong. So you need to be thinking about, if it happens, how will your portfolio companies be prepared for that? With that, thank you very much. I hope you enjoyed that, and I think we'll move shortly to a panel where they can talk more about some of these insights. Thank you.